What is a solo 401k? This is a 401k account specifically designed for self-employed people who have no employees. Whether you got a main hustle and this is your full line of business, or whether you have a side hustle, you can use the solo 401k strategy. The reason why this is cool and why I want you to know about it is you can put $69,000 a year of new contributions into a solo 401k. This could be Roth dollars, traditional, a combination of both. And there's a lot of facets to the solo K that I'm going to break down in today's video, but I want you to know, how does this apply to me? How do I set it up? How do I operate it? How is this different from a SEP IRA or even a traditional IRA and other account options I might have as a self-employed person? All right, let's talk about qualifying for the solo 401k. That's the first thing you need to know is, do you qualify to do a solo 401k? Now, you must be self-employed. This must be selling goods or services with no other employees. Now, employees could be business partners, spouses, or family members working in the business, and you can still do a solo 401k, but you cannot have any third-party employees. The reason you can't is because now it becomes a group 401k. It's not just owners of the business or their family that are playing in the 401k. There's third-party employees, and this morphs over into a group 401k. But there's so many people who are self-employed. We have real estate agents, real estate investors, consultants, people that have a side hustle with no employees that are doing solo 401ks. So if you're self-employed with no employees, this is specifically for you. What if, like, Matt, I have people that are 1099 to me. That's okay. Matt, I have a part-time employee that's only worked for me for 6 months. That's okay. A full-time employee is someone that's worked for you for longer than a year, is over 21 years of age, and if they meet that criteria, now they become a full-time employee. So I want you to think about whether you qualify first for this. If you do, I'm just telling you, this is the best retirement account option out there. It's better than a SEP IRA, and it's better than a traditional IRA. I'm going to break it down so you know why this is a better option. All right, now a lot of people are familiar with traditional IRAs. You can put $7,000 a year into that. You must just have $7,000 of earned income, and you can put $7,000 a year into it. Well, what if I want to put more every year into this? How can I actually build a retirement and do more than $7,000? Well, your next option is what's called a SEP IRA. Now, a SEP IRA is cool. I can put more money in. In fact, I can put a total of $69,000 into a SEP IRA. And you heard me earlier say a solo 401k, you could put $69,000 a year into, but you can put more money in a solo K on less income. So let me explain how that works. In a SEP IRA, the way that works is you can put 25% of what you make into the SEP IRA account as a new contribution. So let's say, for example, you have an S corporation that you run your business out of. You're paying yourself a $100,000 salary on the W-2. You can put 25% of what you made into the SEP IRA, $25,000 in that example. Now, if I contrast that with a solo K, the rule on a solo K is I can put $23,000 in as long as I made $23,000 plus 25% of whatever I made. So if I made that same $100,000 in my W-2 out of my S Corp, in a solo 401k, I can put $25,000, 25% of what I made, plus $23,000. I can put $48,000 in a solo 401k, but I can only do $25,000 in a SEP IRA. Now, many of our small business owners who are self-employed who like to use a solo 401k have an S corporation. They don't want to take a big W-2, even if they made the money. You're trying to have a low W-2 to minimize your self-employment tax. Let me just give another example. Let's say you made $50,000. This is your W-2. You don't get to count your K-1 income. This is the W-2 out of your S corporation. How much can I put in a SEP IRA? $12,500, just 25% of whatever that W-2 is. How much could I put in a solo 401k? Well, 25% of what that W-2 is, $12,500, plus $23,000, which is the employee contribution amount you get to throw in. So you could put a lot more into the solo 401k than you can a SEP IRA. That's reason number one why we like the solo 401k over a SEP IRA. Now, I'm going to come back to some other reasons here to contrast that, but let me break down the solo K, how it works, some of the benefits to it, and some of the things that are unique to it that you can't get in IRAs. All right, let me explain how the contributions work in a solo K. You heard me mention $23,000 as an employer contribution, and then 25% of whatever your W-2 is in an S Corp, or 20% if you're a sole proprietorship of your net profit. But how that works is, that's what I'm putting in each year as a new contribution, okay? And that 25% is kind of the match, or the employer contribution is what it's called. So I can put $23,000 in as an employee contribution. If I'm 50 or older, I actually get another $7,500 on top of that for $30,500. Plus, I get to put money in as the employer, because in a solo K, it's employee and employer contributions, just like a day job 401k where you put money in as an employee and then the company throws in a match. Okay, you're doing the same thing here with a solo K. It just happens to be that it's you putting money in as the employee and then your business also putting money in, because you're such a great employee, to your 401k account as the employer contribution. But we're going to maximize that employer contribution to the maximum percent the IRS allows, which is that 25% of whatever your compensation is. So at the end of the day, I could put $69,000 into the solo 401k, and if I'm 50 or older, I get another $7,500 on top of that. Now in a solo K, you can do traditional or Roth, or a combination of both. So that $23,000 that I put in, I could say, do I want to do traditional dollars on that and get a tax deduction? Am I trying to save taxes now? Or do I want to do Roth dollars that are tax-free, no deduction when I come in, and I contribute the money, but it's going to grow and come out tax-free later in retirement? You get to decide on that. I got other videos breaking down traditional and Roth, but you can decide what you want to do. Now, on the employer match, on that 25%, the employer contribution, you can also do traditional or Roth. This is a new rule that came about in 2023 where the employer contribution can now be Roth. Before this, you could only do traditional contributions as an employer. So now you have the option of doing 100% Roth, all employee, all employer contributions can be Roth if you want in your solo K. Now again, you get to decide. You can do a little bit of each. You can go all in one or the other. It's up to you. And there's pros and cons. Like, am I chasing tax deductions now? Like, let's say it's end of the year right now. We have a lot of clients that like to set up solo Ks at the end of the year. They're trying to throw their contributions in. And the reason they want to do that is they're trying to get tax deductions to save on taxes now. And that money's going to grow, and they don't pay taxes, they're investing it, but it's going to come out and you're going to pay taxes. You pull the money out at retirement. All right, so just keep that in mind. If you're chasing tax deductions now, it will come back later as you're pulling the money out in retirement. Now, I want to talk about timing of these contributions, because the rules are a little different than IRAs, and you also have to have the solo 401k set up in time. So if you want to make sure you get the max amount of contributions in, you want to have the solo 401k set up before year end. Now, right now it's September. We have a special in our law firm and at Directed IRA where we set up solo 401k accounts. You can save a couple $100 in your account and in the solo 401k plan setup. So it's a great time to go in, get it set up right now. Go to kkslawyers.com or to directedira.com. You can get started, set up the solo K now, and do it at discounted pricing. The reason we offer a discount right now is because we don't want everyone running in December trying to get this set up. It overwhelms our team. We always get more solo 401k setups in December than we get the whole rest of the year. Why are they doing that? Because they want to maximize contributions for tax deductions in 2024. So the deadline is December 31st, 2024, if you want to take full contributions for 2024. Now, there's some exceptions to this, but I just want to say, if you want to keep it simple, just get it set up now. Don't wait until 2025 to try and get 2024 deductions. Here's why. Now, remember, there's two contributions here happening. You want to make the employee contribution and the employer contribution. Well, that employee contribution, for those of you that are S Corps, that needs to be on your W-2. You're going to be doing that in January of 2025. So I've got to include that contribution on the W-2, even if it's Roth, where I'm not getting a deduction, it's still on the W-2. So we've got to have the contribution in time. Now, the rules say the contribution deadline requirement to get the actual money in is the company tax return deadline. So if you're an S corporation or an LLC taxed as a partnership, your tax return deadline is March 15th. However, it is plus extensions. So if I extend my S corporation return, that March 15th deadline is now September 15th. So I actually don't even have to put the money in until September 15th. But it had to be on my W-2, which was due in January of 2025 for the 2024 tax year. Also, there's an argument that you must have the plan set up in the tax year and able to make what they call an elective deferral, which is an employee contribution. So bottom line for you S Corp owners in particular, if you want to make full contributions, get it set up before year end. Yes, I don't have to actually get the money in until the tax return deadline plus extensions, but we want to make sure it gets on the W-2 and we have the plan set up before year end. Now again, for you S-Corp owners on the employer contribution, this isn't going on your W-2, but this will be on the company tax return as an employee benefit for the retirement plan contributions. So the company expenses this, traditional dollars, it's going to be expensed on the company return. And if it's Roth dollars, it's actually expensed there too. And the company 1099s you if you've made Roth contributions. Now, if you're listening to this and you're like, Matt, it's already 2025. I didn't get it set up in 2024. Can I still set up the solo K and make contributions? Yeah, up until the tax return deadline plus extensions for S-Corps. But you're only going to be able to get in the employer contribution, which is 25% of whatever your W-2 was. We can't make the employee contribution because that had to be on your W-2, which is due January 31st of 2025. But you could still make the employer contribution. So if it's like May in 2025 and you're listening to this and you're like, I want to do a solo K for 2024. We still could. You can still get it set up. So you would have had to extend the March 15th deadline to September 15th. As long as you did that, you could still set up the solo 401k. Now, what if I was a sole proprietorship, Matt? I was just an LLC, sole proprietorship, or I just had a sole prop. I didn't even have an entity. Can I still do the solo K? Yes, up until April 15th, which is the tax return deadline for a sole proprietorship, but it does not include plus extensions. It's April 15th period. Okay, so as long as you set up the solo 401k by then, you could still do solo 401k contributions for 2024. All right, if that was all a mess to you, just remember to be safe, just set it up before year end. Then you're good no matter whether you're an S-Corp or a sole prop. Worry about get the contributions in later, but get the plan set up before year end if you want to make contributions for that tax year. All right, now let's talk about the process to set up a solo 401k. A solo 401k is an employer plan, so it requires a plan document. IRAs are just set up with forms that you fill out, and there's model forms from the IRS. So when you're setting an IRA up account at our company directed IRA, we're using the model IRS forms and a custodial agreement. But a solo 401k has to have a plan document that is pre-approved by the IRS. Now, our law firm, KQS Lawyers, has a solo 401k pre-approved plan document where you can maximize contributions, you can do Roth, you can do conversions, and you can hold alternative assets. You can buy real estate, you can invest in private companies, you can buy crypto. These are all things you can do with a solo K at Directed. Now, if you're like, well, Matt, I'm doing a solo K at Charles Schwab, and Charles Schwab's free. Should I use them? Yeah, if you want to do stocks, but that solo 401k plan only works when you're at Charles Schwab because you have to buy what they sell. They're setting up a solo K for free or a nominal fee, but that's because you're going to go buy all of your investments with them. They're going to make the money back on that. When you're at Directed, we don't make money on your investments. They're self-directed. You're investing whatever you want. And so we have a fee for our plan document, which has some cost to it, and that's what our law firm sets up. It's $1,000 to do a solo 401k plan. There's a discount right now. Plus our fee is $395 at Directed for your annual account fee for your first account under the solo K. But let's say you have a spouse who wants to contribute to the solo K. They could do that too if they're working in the business. Each additional account is $295. Okay, so just want to give you an idea of the logistics of it and setting it up. It's two things. It's a solo 401k plan that the company adopts for the benefit of its employees, plus each employee, which is only you if you're the business owner, maybe it's a spouse or a business partner might have accounts in it too, but you individually have an account, which you could have two. You could have a Roth account and a traditional account. So it's kind of like Microsoft, for example. Microsoft has a 401k plan document that the company adopts for the benefits of employees, and then each individual employee, Bill Gates, has their own account under the 401k plan, all right, that they make their own contributions to it, but the company has a plan document, and then each individual has an account. That's the same thing you're doing in a solo K. We establish the plan document. The law firm does that. The lawyers advise you on how to use it, how to contribute, all the questions you might have. And then the team at Directed opens up the account. We're doing statements. We'll do any tracking for tax returns. I'm going to get to the tax reporting later here. But we're helping you with the account as you're investing it. All right, let's look at the diagram on how this works. You can see we have a company here that is adopting the solo 401k plan. Let's say that's your company, ABC Enterprises, Inc., or whatever your company's called. And it has a 401k that it adopts, a 401k plan. You are the owner of the business, right? This is the solo 401k that you're going to contribute. You can actually do 23k as an employee, and then the company can do up to 25% as a solo 401k employer contribution. Okay. Now, in addition to putting new contributions in the solo K, you can roll over old 401ks as well. You have an old employer 401k. We get this a lot. Someone leaves corporate America, they have a 401k, and they're like, I'm going to do my own business. I'm starting my own business with it, and I want a solo K. I'm going to roll my old employer 401k into the solo 401k. And you can roll over old employer 401k dollars, traditional 401k dollars, and Roth 401k dollars into your new solo K. You can also roll over SEP IRAs into a solo K. Those are going to be traditional dollars, so it'll be a traditional account in the solo K. Or, of course, traditional IRAs could get rolled into a solo K as well. Now, one of the roadblocks is you cannot roll a Roth IRA into a solo 401k, even if you have a Roth account in the solo K. It's one of the weird, quirky tax rules out there. You can roll out of Roth 401k to Roth IRA, but you can't go Roth IRA to solo 401k. It's totally nonsense, but that is the tax code for you. So as you can see here, we have a company, creates a 401k plan, owner of the business contributes as the employee, the company is contributing in as employer, and then again, you'll have an account if you do Roth, and traditionally you have two accounts, or you can just go 100% into one. Now, one of the other unique things of a solo 401k is you can loan yourself money from the solo 401k up to half the balance of the 401k account, not to exceed $50,000. So take that new business owner that set up a new business, you're trying to fund your business. We've seen a lot of people say, hey, I'm going to roll over my old IRA or my old employer 401k into the solo K, and then I'm going to loan myself half the balance of the 401k, not to exceed $50,000. And I'm going to use that 50K, let's say in that example, let's say you had a $200,000 old employer 401k. You rolled into the solo 401k. How much can I lend myself? Half the balance, which would be 100, but not to exceed 50. So I could really take a maximum of 50,000. But that loan I take personally, and I could put it right back into the business to go fund that new business, help buy inventory or hire employees or whatever startup costs you might have. Now you got to pay that loan back over 5 years, making at least quarterly payments. The interest rate is prime plus 2%. But the cool thing about that 401k loan is that interest you're paying back into your 401k, tax deductible, because that loan was used for your business. Now, if you went and loaned the money and you did a personal thing, you went to Vegas or you bought a boat or whatever, something totally financially responsible, which I wouldn't do, but just as an example here, the interest you're paying back to your 401k isn't deductible. But if I used it and put that money back in the business, that interest now that you're paying on the loan back to your 401k is tax deductible by the business. Now, I want you to think about accessing your 401k for that, or maybe even using the 401k, taking a loan out to pay off high interest debt. You got credit card debt at 18 or 20%. Let's use that 401k loan strategy. Take the money out of your 401k to go pay off the high interest debt. Now, I want you to pay that money back to the 401k, all right? That's the goal here. I don't want to raid the 401k. I want you to actually have money in your retirement, so we want to pay it back over 5 years. And if you don't pay back the 401k loan, it's distributed. You would have to send a 1099-R to yourself for the distribution, and now that goes into your taxable income. So be careful on that. If you are using the 401k loan option for your 401k, just make sure you're paying it back. Have a plan to pay it back. Don't be raiding your retirement account early. You need this later on in life. You will thank yourself when you're 59 and a half. All right, so I got the solo 401k plan done. I got my solo K account ready. I've made some contributions. Maybe even I rolled over some other money. And let's say I've got a Roth account. I'm doing a Roth solo 401k account and I want to invest it. All right, what do you want to invest it in? Now, most people use us at Directed because they want to buy real estate or a small business or a private fund, and we can invest your account into that. Your 401k can also own an LLC 100%, and that LLC can go buy investments. There's lots of options there. You could even just buy a mutual fund or an ETF while you're building up the account before you get an alternative. Okay, we have options where you could buy that too, right out of your account. So once it comes to investing though, that's up to you. You're deciding how to invest it. That's why it's a self-directed solo 401k. No one's managing your money. You don't have an advisor charging you fees. It's you. You're captain of your own ship. Now, you can go get an advisor. Of course, there's advisors that will help you with that if you want, but I'm just saying, you're the one self-directing, choosing the investments for the account. All right, now you need to know a couple of tax forms that are going to be required in this process. The first is called a 5500EZ. The 5500EZ is a tax return required for 401ks, but there's an exception for solo Ks where the IRS says you do not have to file this form until you hit $250,000 of assets. So if you opened up a solo 401k and just made your first year of contributions, and let's say you contributed $20,000 in the first year, the IRS doesn't want to hear from you. don't file this form. But once your account balance hits $250,000, you have to file this 5500 EZ. Now, if you have an account with us at Directed, we handle this filing for you. We will do it for you on an annual basis automatically. You don't need to worry about it. Also, if you terminate a plan, though, you have to file a 5500 EZ regardless of the dollar amount that's in the account. You could have $20,000 in the solo K and you terminate the plan, and let's say you roll it to an IRA or you even took a distribution, you still need to file a 5500 EZ in that instance. But like I said, if you have an account with us, we handle that stuff for you. Now, the other tax document you'll need to do on a solo 401k is a 1099-R. A 1099-R sometimes happens either when you're doing a Roth conversion, you're converting traditional solo 401k dollars to Roth, or you're taking distributions out. Let's say you're 59 and a half, or maybe even took early distributions. You have to send a 1099-R from the plan to you as the account owner. All right. Now, again, if you have an account with us where you're using Directed, we handle the 1099-Rs for you. Now, there are some people who are like, Matt, I don't need an account with Directed. I'm going to handle it myself. I'm going to open up a bank account. We have a bank that we work with that's great for that. And you can have a trustee checking account, let's say, and you're the trustee of the solo 401k, and you're going to do all the tax reporting. You're going to do the statements. You're going to be tracking everything, and you can do that. I want to make sure you have a good accountant or someone that's helping you with that. But most clients are going to use our custodial account option when they set up a solo K, where we open an account, we track the money, we do statements, we do your tax reporting when you need it. And that way you know it's all handled and taken care of. And that also means you get access to the team for your questions on how things work. We help educate you on what you can and can't do. Now, even when you have a custodial account with us, we can put that money into a trustee checking account, because you're trustee of the solo K, by the way. As the owner of the business, you are the trustee of the solo 401k, the person responsible for it. We are hired as your custodian, and we help administer that for you at Directed. Of course, our law firm, KKOS Lawyers, sets up the plan document. But you're in control of this. Again, this is self-directed. You're in control of how you invest it and how it's being administered. We're here, of course, as a resource to make sure it's done right. Now, I want to hit a couple common questions people ask. A lot of people are like, Matt, okay, I did a solo 401k, but now I've hired an employee. They're over 21, and they've worked here for longer than a year. What do I do with my solo 401k? Well, in that instance, you can kind of freeze it. There's actually a freeze process of where you do it. There's a form you can complete, and you're not making new contributions. You still have the solo K account open, and you're still making investments with the money, but you're not putting new contributions in. The day that person has worked for you for a year, you cannot put contributions in. So be careful on that. Make sure you're tracking that and being careful about that. 1099 independent contractors don't count. Part-time employees don't count until 3 years, by the way. Full-time employees count at 1 year. So just make sure you're understanding those rules. And again, we can help advise you on that process as you're getting the plan set up where you might have questions. Now, once that solo K is frozen, the IRS expects some reasonable time period. They're not strict on this. There's no hard and fast rule. I've kind of heard 3 years on this of when that solo 401k should be wound down and really just rolled out to an IRA. Whether it's a traditional IRA if you had a traditional solo K account, or a Roth IRA if you had a Roth solo K account. So just be careful if you're using a solo K and then you later on hire employees. Now, one of the cool things about a SEP IRA is the rules on employees are a little more lax, actually. So there are some instances where we like a SEP IRA over a solo K, and here's one. Let's say you have a full-time employee that's already worked for you for a year, and you're like, Matt, I can't do a solo K. I've got an assistant or someone else that works at my company. And it's just one person or two people, but they've only been here a year. Well, in a SEP IRA, you can still do SEP IRA contributions just for yourself, and you don't have to offer it to employees until they've been with you for 3 years. All right, so you have a little more time with employees in a SEP IRA than you can a solo K. Again, I can get more money in on less income in a solo K, but the SEP IRA can still be a good option. You're putting in 25% of whatever your income is, W-2 for those of you with S-Corps. Another question I get is the difference between a self-directed IRA and a self-directed solo 401k. For you self-directed investors, the number one benefit to a solo K, again, if you qualify and can do it, is there's no UDFI when you're buying real estate that's debt leveraged. There's a weird exemption in the tax code that says 401ks, including solo 401ks, are exempt from UDFI when buying debt leveraged real estate. When an IRA buys real estate and gets a loan to do that, it has to be a non-recourse loan, there's this little tax that applies to the profits from the debt called UDFI. I've got other articles, a chapter in my book on it that goes into that. I'm not going to go over it in detail here, but I just want you to know solo 401ks are exempt from that UDFI tax, only on debt leveraged real estate though. So it's a little narrow exception, but it could apply to you if you're doing real estate and want to buy debt leveraged real estate. Now, another question we get on the solo K is, Matt, I got rental properties. I don't have a business where I'm selling goods or services, but I got rental properties. Let's say I got 6 rentals that are owned in LLCs. Can that LLC that owns the rentals create a solo 401k? Unfortunately, no, it cannot, but we got a workaround here possibly. The problem with LLCs that own rentals is they're receiving investment income. It's receiving rental income. It's receiving capital gain income when you sell a property. So that is not income that you can make retirement plan contributions off of. You make retirement plan contributions off of self-employment income, of ordinary income, all right? And so what can I do in that scenario? Can I do a solo K? Possibly. What we do in that scenario, if you really want to do a solo K, is we do what's called the side door solo 401k. We will have your rental company LLC pay a management fee over to a management company, which could just be a LLC or even just a sole proprietorship. You're going to at least have a bank account for it. And then that sole proprietorship is where you're providing services back to your own rental LLC. So let's say you paid $10,000 in management fees from your rental LLC over your sole proprietorship because you're managing that and managing the properties. You'll receive the $10,000 of income in the management company, and then you could use that $10,000 to make a contribution or even just to justify the business as its own entity of which to adopt a solo 401k. Now that $10,000 would be expensed over on the rental properties, but you will pick it up as income over here in your sole proprietorship. Now usually I would never do that. Why would I send investment income over here that's taxed favorably over to ordinary income, self-employment income over here where I got to pay into Medicare and Social Security? I would never do that, except if you're trying to create a business over here of which you can adopt a solo 401k to make retirement plan contributions or maybe even roll over other dollars so you can justify having the solo 401k. Now, over time, maybe that sole proprietorship provides some other services, get some other commission income or revenue you can find to put in there. I like that a little bit better to justify that sole proprietorship type entity. Another frequently asked question I get is, Matt, I have a day job with a 401k where my employer puts a match in, but I also have a side hustle. Can I still do a solo 401k? Yes, you can. Okay, you can have a solo 401k at a day job plus a solo 401k from your side hustle. Now, the rules on how you contribute are a little tricky. Basically, you can't double up on employee contributions of 23k and 23k in the day job 401k and in your solo 401k, but the employer contributions, which is really $46,000 left to get you to the total of $69,000. There's no rules on doubling that up. So it's a little tricky there. You want to talk to one of our tax lawyers on that if you're trying to strategize maximizing a day job 401k. Maybe you put in the maximum contribution to get the match from your employer, and then in the sole proprietorship or your side hustle on the side, we do the solo 401k there, and you put all the rest of the 401k dollars you want to contribute into that company because you can self-direct that. You can invest in assets you know. Your day job 401k is at XYZ company that just lets you buy target date funds and ETFs, and you might not be excited about that. So let's put more dollars in the solo K if we can so that I can have better investment options and can self-direct it. All right, and another frequently asked question, sorry, I'm just going to keep rattling these off, is like, hey, Matt, I have a business with employees. My spouse has a business with no employees. Can my spouse set up a solo 401k? Yes, they can. Okay. Your spouse can have a solo 401k in their business with no employees as long as it's separate from your company that has employees. It's not like providing services to it or getting income from your business with employees, as long as they're totally separate businesses. Let's say you're a dentist and your spouse is a real estate agent. All right. In that example, you could totally do that. Okay. Spouse could have a solo 401k in their real estate business as a real estate agent. They're getting commission income and they can go and set up a solo 401k. Now, you as the dentist, if you're going to do a 401k, you have to offer it to your employees and everybody in the dental business and maybe any other dentist or hygienist or office people that work in the business. So look at that carefully if you have a spousal situation. As long as the businesses are separate, the spouse that has no employees could do a solo 401k. Now, we've done webinars on this. I have a whole chapter in my book on the solo 401k. Our team at Directed can help answer questions on it. Our lawyers and KKOS lawyers can advise you on it and get it all set up. We are here for you. And remember, we've got a special right now. We can save a couple $100 from the account fees at Directed. You save $100, $50 to $100 at KKOS lawyers and setting up the solo 401k plan. Take action now. We want to help you get this set up. The solo 401k is perfect. It is the retirement account of choice if you're self-employed with no other employees. You business owners that have employees, you can't do it. Like, I can't do the solo 401k. I wish I could. This would be my first choice of a retirement account, but I can't do it because I got other employees. We have a group 401k. I do the backdoor Roth, HSA, other strategies. But for those of you that are self-employed with no other employees, this is the one. This is the one to do first. Do this even before a Roth IRA, assuming you want to do more than $7,000 a year. We love the solo 401k. We've had a lot of clients have success with it. And remember, it has many options. You can self-direct it. You can do Roth accounts. You can take a loan from it. You can have a checking account out of the solo 401k's name, even without an LLC. There's so many benefits to using a solo 401k. We've got a lot of research over at directedira.com on how the solo 401k works. Make sure you check that out. And also make sure you subscribe to the channel. If you're watching this here on YouTube, if you're listening on the podcast, make sure you're subscribed there too. Please give us a great review. Leave some comments below. Thanks for tuning in. I'm Matt Sorensen. We'll see you next time.